Hi, we're talking about Your Money Matters on NDTV Profit because we understand that your money matters. Now today we're talking about mutual funds because ultimately the rally that you've seen in the equity markets over the last few trading sessions has changed the texture in all likelihood of your portfolio. It's looking much better, I'm sure, than it looked at this time last month or any time over the course of the last few weeks, barring the last week. We're going to talk about strategy and how fund managers are looking at their own investment thesis and whether or not my guest today feels like things are going to look up going forward or whether uncertainty is still something that you should be concerned about. Joining me is Satish Ramanathan, the CIO of Equity of JM Financial Asset Management. Satish, thanks so much for taking the time and a pleasure speaking with you. Do you think that this latest move that we've seen in the equity markets was coming? That's the first question, of course. And what does that indicate? Of course, this is a very small move if you think about it long term, but tell us what you make of it.
So I think there's been a rally pending for some time because the markets were oversold. There was extreme fear. And all of this put together has led to this kind of a situation where you have a bit of a rally coming through. Also, a lot of money has moved to the sidelines. So, things have led to this kind of a panic situation, which will kind of ease. And this is a sign of the market easing and pulling back a little bit. That said, there are also pockets of value emerging in the market. So for a fundamental long-term investor, I think it makes sense to start putting in money into some of these sectors and stocks.
Let's talk about some of that because I look at the snapshot of your portfolio, and even now that might be a little dated because I have data from the end of last month. I'm wondering what has changed over the course of the last few weeks, Satish, because even if I look at your top holdings and I look at the performance of the markets over the last 1 week, that itself would have given your portfolio, and I'm talking about the FlexiCap fund in particular here, that would have given that portfolio a shot in the arm because you're talking about HDFC Bank, ICICI Bank, then the financials doing incredibly well. So give us a sense of how things have gone for your portfolios over the last 3 or 4 weeks and how have you adjusted your strategy?
Right. In terms of our strategy, what we felt is that given the global uncertainty that's taken place due to the trade wars, trade tariffs, and several other things, what we have decided consciously is to move away a bit from the external sectors and move into the internal sectors. So what we have done is to move into banking, financial services, and consumption, which is more predictable. That said, we are still a little cautious about the growth because the growth momentum in the economy is clearly not there, and it needs to pick up base gradually over the next few quarters. Corporate health and corporate earnings are, of course, excellent, and they will continue to trend up. So this is what we have done in terms of our portfolio allocation. If you see our portfolio, say 3 to 4 months back, we were not necessarily as overweight on financials as we are now. In fact, we were slightly underweight. So what we have done is that we have gone equal weight to slightly overweight in the financial services sector on the expectation that interest rates will ease, inflation will ease, and growth will revive. So that was being the significant change in the portfolio.
Okay. I'm just wondering about the market cap allocation as well. Has that changed materially at all? Because you still have about 57% large cap, but you have 24% small cap. Does that indicate that you see that certain excesses and froth that had built up in the system has settled, has dissipated, and there are opportunities in the broader end again?
So what we have done at the portfolio level is to kind of reduce the number of moving parts. So if you see the portfolio, we have reduced the number of stocks from about 60 to about 50. And that continues to be the strategy where we will back some of our high conviction ideas with the cash that we receive or internal allocation and reallocation of cash. And that 34% of small cap represents our higher conviction ideas in that space. And large caps is what we have increased over time from about 37% in August 2024 to about 60% given the liquidity issues in the marketplace as well as the attractive valuation.
Interesting. Uh, would that be the reason the selling of what you mentioned, the reduction of the size of the portfolio in terms of number of stocks? Is that the reason, Satish, you have a 147% turnover ratio in the month of February? And is that more elevated than you're normally going to see in your portfolio, or is that par for the course?
I think it's slightly elevated. Our typical turnover strategy is about 100, over 100%. But this month was a little higher, primarily because of the rationalization that we had to undertake and also shift from some of the lower liquidity names to the higher liquidity names. Also, we needed to prepare just in case that there was any redemption. We needed to prepare for that. So it was all planned out in that sense.
Okay. And did you face significant pressure on redemption, or is this? And the reason I'm asking is because at least on the face of it, while there's been quite a lot of attention on the system level, on the industry level, on the cancellation of SIPs, the gross number seems to be intact. And there seems to be, at least the anecdotal evidence is that there is money being deployed through lump sum as well, Satish.
So there hasn't been any redemption pressure as on date, but it is likely that as the markets move up, the people who missed selling the rally may actually come back and sell. So we need to be a little cautious here, and it's not, we shouldn't take anything for granted.
Okay, point taken. In terms of the average holding, so your investors also understand, you've already mentioned a couple of things that I think are very important in terms of the construct of your portfolio and what you anticipate in the coming months. But what is the average holding period of the stocks that you have in your portfolio? And you mentioned that the 24% of small caps represents your high conviction ideas. How much time would you normally hold these stocks for?
So we hold these stocks for a fairly long period of time. Some of these stocks have been in the portfolio for 3 years, 4 years, some of them a little less. The primary reason why we sell a stock is A, it has reached our target price, and B, there is a fundamental deterioration which is not to our liking, and C, there is a better option or opportunity elsewhere. So it's a combination of these three factors that compels us to sell. But apart from that, we do hold stocks for the medium to long term in the small and mid cap space because that's the only way you can create value and appreciation.
Okay. I want to look a little forward and ask you to paint a picture for me for how you anticipate the new financial year will go. And of course, I'm not asking you to make predictions, but what are your base assumptions at this stage? The jury's out about whether earnings will come back and to what extent it will come back. What is your base case assumption for Nifty earnings in FY26 in the next financial year, and how are you basing your strategy?
So let me put it this way that if you look at the three constituents of the GDP of net trade, or rather four constituents, net trade plus consumption plus government expenditure plus investment. We think all three to four factors are actually a little depressed. and they will have to work themselves out, and the growth will only accelerate as we move ahead. So the next 2 quarters, our base case assumptions for earnings growth would be about 10%, and that appreciating to about 12 to 30% in the second half of the next financial year. So that's our base assumption. And we think that the primary growth drivers would be in utilities, would be in the BFSI space, and consumption space as well.
Okay, so then last point, Satish, from that perspective, of course, we've seen a comeback over the last week or so, and it's a good start to the trading week as well. But then, would you say that caution is the better part of valor in the new financial year, and investors should guard against oversized expectations for returns?
Yes, I would definitely urge investors to remain cautious and to wind down their expectations, primarily because I think the global cross currents are too many and too unpredictable for anybody to take a call. Any sector can move any which way. And therefore, that's the reason why investors need to stay guarded, maintain a fair bit of liquidity, and not to get exuberant at any point in time.
The last question that I have for you, Satish, is as a fund manager, of course, you're looking at all of these several moving parts. As CIO, of course, there's even more that you have to contend with in terms of strategy for your fund house. What, in your opinion, is the biggest risk to guard against from your perspective, not the investor's perspective?
So, from our perspective, I think what we need to do is to maintain a level balance across sectors, not to get carried away into any one sector because it's blown up for the past 1 month or anything of that sort. Maintain the diversification, maintain the discipline, and probably this year would be a little bit more of a trading oriented strategy than what we will see in the past.
So you're going to have to be more nimble. That's what I'm getting from that. Satish, thanks so much for joining me today. Pleasure as always having you on the program.
Thank you so much. Pleasure being with you guys.